Welcome back. आप देख रहे हैं Welcome back. You're watching the Money Show with me, Kavita Thaplial, and let's talk about debt funds. And today we'll be talking about short-term debt funds and their performance as far as your portfolio construction is concerned. And with me is Shweta Rajani, Head Mutual Funds, Anand Rathi Wealth. Shweta, good evening and welcome to the show. Clearly, we'll be focusing on the placement of short-term debt funds in your portfolio and the kind of returns one should be expecting and the reason why one should be having them in their portfolio. Having said that, for general knowledge, how exactly do short-term debt funds work and how would you explain that to our viewers?
Good evening, Kavita. Yes, we have 16 odd categories in debt funds. And if I focus at categories which would, be considered worthwhile investing from a less than 1 year holding perspective, because, we are talking about short term here. So there is liquid and overnight, which you would ideally consider if you want to park your money for a few days or few weeks. Yeah. So if it's less than a month, overnight and liquid become the two categories. If you're looking at an investment horizon of somewhere around 6 months to a year, then you have categories like money market, ultra short duration, low duration. So this can be considered for, I would say, anywhere between 6 months to maybe even 1.5 years if you want to stretch. Then if you're looking at a 3 year kind of a horizon, 2 to 3.5 year kind of a horizon, then you have the short duration category. So this is from the shorter end perspective or 3 years and below kind of perspective. The other categories which are there on the debt side, I'd say that would be more focused towards 3 year plus horizon. So there you'll have, your medium duration, banking and PSU, uh, uh, credit opportunities, corporate bond, medium to long durations, depending on what's your investment horizon, but 3 years plus.
All right. I also want to understand the kind of earnings and the kind of return one can expect from short-term debt funds. But before that, I think you might also want to explain the kind of relation these funds have with the interest rate scenario.
Yes, absolutely. So, I'll break it up into two parts. One is the yield or the return expectation that one can have. Second would be the interest rate implication. So, an overnight or a liquid fund today would yield you around, let's say, closer to a 6.75-7% range. Here, the relation with the interest rate is very minimal, negligible to, I'd say, very minimal. Then coming to the three categories, which are for closer to, like I said, 6 months to a 1 year horizon. That's basically your low duration money market and ultra short duration. The return expectation that you can have at this point of time, as we call it the expected yield to maturity, which means if you hold on for that horizon of, a year or 6 months, what is it that you can expect here? This would be again anywhere between 6.8 to 7.2. It slightly differs from a fund to another fund. Within this, the money market and the ultra short duration category have a duration or a modified duration, as we may call it, of around zero point 0.5. Now, what a modified duration means is it's your sensitivity to an interest rate movement. To put it in very simple terms, it explains the impact on the return for a 1% movement in the interest rate. For example, if my duration is zero point 0.5 and let's say the interest rates increase by 1%, it means the return of my debt fund can fall by a zero point 0.5. So it's an inverse relation. Increase in interest rate would have a negative impact on the return to the extent of the duration of the portfolio. Coming to the low duration category, the modified duration there tends to be around a year, 0.9 to 1, which means a 1% increase in interest rate would mean a 1% drop in return and vice versa. So if there's a fall in the return, your duration is 1, you could get a 1% positive impact. That's briefly on the short-term investment segments, the return expectation and the yield impact.
So how important, Shweta, now how important it is for one to consider the interest rate play before having a short-term debt fund in their portfolio? Should one look at the requirement that obviously would also mean looking at the duration that you're invested into and interested into, but at the same time counting the interest rate play also? What should be the criteria?
See, absolutely. The objective of investing in a short term paper is to basically meet your liquidity requirements. It's not so much to make returns from the debt portion of the portfolio. If you're looking at 6 months, it means you have a liquidity need over the next 6 months, which is where you're parking in that segment. So it becomes very important that whatever is your investment horizon matches with the duration and the average maturity of the portfolio. So if you're looking at 6 months parking, you will need that money within 6 months, then you go in for a money market or a ultra short category. If you know that you're going to need money, let's say after 12 months or 15 months, then you go in for a low duration category. If you know that you're going to need the money within the next month, anytime, then you go for the liquid fund because there, your maturity is, like I said, 30 days or somewhere around 30 days. So this will help you that you don't see too much of fluctuation in the return because of an interest rate movement. If you want to play an interest rate cycle, then it becomes like you are expecting that the interest rate is going to fall. So you'll invest in a fund which has a higher modified duration. So then when that interest rate falls, the appreciation that comes in the price because of the fall will be to the extent of the duration. But that I would not advise you if you are looking at a parking which is less than a year. Unless you have a very strong opinion on where the yields would go.
All right. What are the kind of short-term debt funds would you recommend to our investors?
So, just 2, 3 points over here. What you should consider before you are looking at. I already mentioned the categories that you can consider depending on the horizon. Few checkpoints is one. Every fund in the fact sheet publishes what the net yield of the fund is. So look at that. That is an indication of what return you can expect in the portfolio. Second, I would say look at the portfolio quality. It becomes very important. What's the kind of papers that they have invested into? Do they have more of GSEC papers or AAA papers? That is a second check that you should do. Third is check the expense ratio of the fund. The lower the expense ratio, the better it is because expense ratio also eats away uh, some portion of your return, and it's that much more important when it is a debt fund because the returns you're talking about are 6.5 to 7%. So few funds that I would suggest is you can consider. Let's say I'll just name one fund in each of these categories. If you're looking at a money market fund, then you can consider a Aditya Birla Money Market Fund. If you are looking at a low duration fund, then you can look at a Kotak low duration fund. If you're looking at an ultra short duration fund, then you can look at an SBI ultra short duration fund. These would be some of the funds. However, as I said, three things that you should check on. Finally, the duration of the portfolio.
All right. So clearly, this is what you need to keep in mind before adding a short-term debt fund in your portfolio. But then, Shweta, time for viewer queries also. And first question is from Manisha. She says that she's 52 years old and she lives in UAE. Her goal is to have 5 crores in 8 years for retirement as retirement corpus, and she wants to understand what should be her monthly SIP amount for the same goal. And she also wants you to suggest her some funds. Currently, she said that she's investing 50,000 per month in Mira Asset Emerging, Canara Bank Emerging, Kotak Emerging, SBI Small Cap, PGI Mid Cap, Canara Bank Small Cap, Blue Chip, Parag Parikh Flexi Cap. So these are the funds that she's investing. I think 50,000 is the amount that overall she's investing in these funds. Shweta.
Sure. Manisha, one thing that's good is you've defined your goal, so you know what you're targeting. It only helps you strategize, in a proper fashion. Now, I'm considering that this is only the equity portion of the portfolio. You'll have other investments too, but assuming a rate of return of, let's say 14 odd percent that you can expect from equity, which is also the historical track record. Your 50,000 of investments that you are doing could, uh, and whatever you've accumulated so far over the 8 schemes that you're investing into, roughly can take you towards a 5 crore of investment over a 8-year period. So 50,000 monthly, you may have to step it up by 10% every year. You'll also have, I'm guessing, the query that I had also had a lump sum that you've accumulated to a certain extent. So a 3 lakh of lump sum along with a 50,000, step it up 10% every year. That will take you to your target of 5 CR over the next 8 years. So that's at the portfolio level. Coming to the schemes that you've mentioned, some of your schemes are good and you can continue holding on to them. So something like a Canada blue chip fund you mentioned in Kodak Emerging, Mirai Emerging, and SBI Small Cap, these are good funds. Continue to hold on to them. What you also need to take into account is have a good blend of large cap, mid cap, and small cap in the portfolio. So some schemes that I'm asking you to exit is PGIM mid cap. You already have a Kotak Emerging, so you don't need one more mid cap fund. You can look at multi cap funds because there you will get exposure through both large, mid, small. So that's maybe a Kotak multi cap is what you can consider here. Canada small cap, instead of that, go in for SBI Contra fund. So it gives you a different style in the portfolio. You anyways have a SBI small cap too. Within the flexi cap category, again, I would say don't go in for a Canada emerging, but something like an HDFC flexi cap is something you can consider. So 3 funds where I would suggest you to make some changes.
All right, Shweta, let's move on to our next viewer, Rahul Yadav, and he has Parag Parikh Flexi Cap, SBI Mid Cap, Axis Small Cap, Canara Beco Small Cap in his fund, 4,000 rupees each, and for 25 years with a 10% step up is what is his goal is. Okay, I think I have Rahul on the phone line with me. Rahul, hi.
Hi.
Is there anything you want to add in your question? Thank you so much for sending us your query. Is there anything else you want to add?
Ma'am, I want to know that is this portfolio good for me for 25 years? I want 5 crore for my retirement purpose.
All right, so that is what I think Shweta will be answering, and 10% step up is what you have also mentioned. Great. Shweta.
Yes. Hi, Rahul. So, if you continue doing 4,000 with a 10% step up over the next 25 years, looking at the historical track record of equity, you would get to a 1 crore number. So now if you want to have an objective, which is 5 times of where this could take you, you'll have to scale up the SIP that you're doing. So maybe start off with a 15,000 per month SIP and then do a 10 to 15% step up every year. That will help you over the next 25 years to get to your number of 5 crore plus objective. Coming to the schemes, right now it's a small amount, 4,000. So you're putting 25% in each scheme. It could lead to a concentration. So you should look at having around 8, 9 schemes in your portfolio at least. You can gradually, as the portfolio increases, scale it up further. Second observation is of the 4 schemes, there is almost 75% that's going towards mid and small. It's good to have mid and small in the portfolio. And also, if you look at the earnings potential, mid and small caps tend to have a higher potential, but you need to balance out between your large cap, mid cap, small cap allocation. So therefore, you should, consider categories like flexi cap, large and mid, where you can get at least a 50% large cap exposure. Coming to the schemes, Access and Canada fund that you have, the small cap funds, you can continue to hold on to it. The 2 other schemes, Parag Parikh Flexi Cap and SBI Mid Cap, I would suggest you to change those SIPs. Parag Parikh has some bit of international exposure. Domestic equities have far better potential. So sticking to something like a quant active or an iProof focus would be better. Instead of, like I said, SBI Mid Cap is another fund that you can consider switching. You can go into an SBI large and mid cap fund, same AMC, a fund which gives you a more large cap exposure is what I would suggest.
Rahul, thank you so much for sending us your query, and thank you so much, Shweta, for being on the show and helping our viewers with their mutual fund
Thank you.
queries. On that note, let's dip into a short break, but then more on the Money Show after this break.